Today's guest is someone you might have heard of. Her name is Miss Melody Wright, and she is very well versed in the housing space. And her and Ken have different opinions in what's going to happen in the next few years in housing. And they had a great debate that we're going to pop right into. So I'm going to be the moderator here between Ken and Melody because, while you guys agree on some things, you also disagree on some things with the housing market. And I think it'd be really interesting to get two very intelligent people's opinion and let the audience kind of learn and decide for themselves. So I wanted to start with affordability being a core issue on whether prices crash or stabilize. So Ken, do you believe that affordability right now is an issue for the average home buyer?
Huge problem. Yeah, both obviously on the mortgage side and on the, if you own a home, all the costs to own that home, property tax, insurance, utilities, those kinds of things. So yes, affordability is a big deal. Really on the rental community as well.
And then Melody, how do you feel about affordability currently and how that's playing into everything?
Yeah, I think that is the deal. And that's why we've had such a frozen housing market, with the worst sales since 1995 on the existing home side. And we've increased population by 20%. There's something wrong, obviously, in the housing market. And I think it's that, really your first-time home buyers have been priced out by investors and they can't afford, to move to form households. So yes, huge problem.
So Melody, do you think that this market is fundamentally different than 2008, or do you think that this is a similar market to 2008?
I think there are differences and similarities. I think that what a lot of people, we heard a lot of what I call credit quality gospel singing coming out of the last crisis. And I was a part of that because my job was to go out, make sure that Dodd-Frank got implemented, that we were, underwriting quality loans. But the problem in 2021, they kind of removed the debt to income threshold. And the automated underwriting systems in the back end that are approving those mortgages, I think that people figured out how to game them, while at the same time you had credit scores that were inflated because, you had all the moratoriums on evictions, moratoriums on, the forbearances in the mortgage space. And then so I'm primarily talking about what I call agency or those prime loans. But on the FHA, there's no question that those are very poor credit quality. And even those credit scores were inflated. And they're a much larger percentage now. That's what a lot of people don't know is, back during the last crisis, FHA was around 7%. They've doubled that. And then you also have the private market, which is about 3%. And that's already double-digit delinquent. And so we kind of have it's not the same, but there are definitely similarities. And another similarity is that there's just speculation. And I think that actually the speculation is much worse during this cycle.
And now a word from my paid sponsor, PadSplit. Look, if you've been trying to make single-family rentals pencil out in this market, you already know that the math can be tight. With high rates, properties that would have cash flowed 5 years ago now often break even at best. So what do? You wait on the sidelines and miss out, or maybe you find a better model? That's why I want to talk about today's sponsor, PadSplit. Here's an example of the math in some markets. A 4-bedroom renting for $2,700 as a traditional rental may be able to gross over $6,000 a month in a co-living setup through PadSplit, depending on location, occupancy, and costs. The same house can potentially more than double the gross revenue in the right market. And before you think, that sounds like a headache, PadSplit helps with member screening and rent collection while still allowing you to operate the property and make management decisions. This is one strategy investors use to try to make deals work when traditional rentals don't pencil. If you want to see the numbers for yourself, go to padsplit.com/hosts. I'll have a link in the description. Just run the math on the property you already own and see if it's a fit. You might be surprised.
So Ken, how would you respond to that?
2008 for me was just pain. Like that's what I remember. I went through it. I didn't completely understand what was happening at the time. I wish I now knew what now I look back, I was like, darn it. Like it was all, to me, it was very predictable if you take a look at what happened. And I think you have to go back at before 2008. So what happened was we had two presidents that were pushing the American dream. And, one was Clinton and the other was Bush. So two different colors, guys. So, that was, I think that's really, really, really important because they were pushing affordability. They were pushing all these things. And what it did is it pushed homeownership up to its highest we've seen. It was at 69.2% home ownership. Now, the side of the equation that I'm on is the rental side. So what was happening is I had multifamily and I was a landlord. I was all that stuff. And I was losing people. I was losing all my tenants to people that were buying houses during that run. And why? Because you could fog a mirror and get a mortgage. And so I actually we had renters coming into our apartments that could not afford the rent. And then they would go buy a house. I was like, okay, there's a problem here brewing. These are people that can't afford a house. Clearly, they can't afford a rental either, because we run their credit. So what we had is this bubble that popped, obviously, under Obama. And so he didn't actually create the problem, but it popped under his presidency. And at that time, we had, so many foreclosures and defaults and all that stuff. And so that's when I really saw what, call it a massive correction or call it a crash or whatever you want to call it. But that's when I saw prices skyfall. They just fell. And the reason is because we had 4 million listings. And the real issue that we had at that time in 2008, I think this is the biggest issue. This is the biggest change from today is post-crash, people only had like $6 trillion of equity in their home. And for there to be a real crisis, you have to have somebody that can't pay something. And in this time around, we have 34, 35, 36 trillion dollars of equity sitting in people's homes. And so while maybe they do have a disruption in their family somehow for perhaps job or divorce or something like that, they're sitting on equity to be able to pay their bills. And that's very different from 2008. And so we had this massive supply of homes, 4 million, that it wasn't until 2016 that it actually got to about 1.5 on MLS at least. So when you have a massive supply like that, it makes a price correction. And that's why I don't see that now, because we're just at 1 million MLS. And I think we have a structural problem with supply. If you take a look, I think, Melody, you mentioned that we had a huge population growth, but the housing hasn't kept up. I know, I think it was in the last 12 years, we had almost 16 million households formed and only 8.5 homes being built. So I think we have a huge supply problem. And I think whenever you have a lot of supply, it's better for the home buyer. When you don't have enough, it's not great.
So
I have sorry.
Please, no, please go ahead. Yeah.
Could I say a couple of things to that?
Absolutely.
So firstly, I want to talk about the equity out there, because I think that people fundamentally kind of misunderstand when you're looking at those aggregate numbers. So one thing that's not captured, Ken, are the payment deferrals, which were the workouts for the Fannie and Freddie, your conventional prime loans, when they did those 18 months of forbearance. Servicers are not even reporting them. And so you basically, what you had is a home equity loan is what that payment deferral kind of was, but it's sitting at the back of that loan to be paid off when you sell the home. So we're missing a big part of that story in terms of that aggregate equity out there. And I have contacted people and asked them, are you in, CoreLogic or Cotality is who does the big mortgage equity withdrawal. And I asked them specifically, how are you capturing these payment deferrals? Because they use public record. They're not. And then the other aspect of it, Ken, is we've had a lot of seller financing, a lot of private note actors come into the space that are doing these things called sub-2 mortgages, all kinds of different things that aren't actually getting reported to credit, because you had these what are called non-performing loan sales that the agencies started doing. FHA was doing them back during the last crisis, but Fannie and Freddie started doing them at scale, selling off these homes to hedge funds. And this is after kind of all the auctions when Wall Street bought them up. And so you have a huge private market that nobody really knows. And then the third thing I would say is, I wrote an article in 2023 called Debunking the Inventory Shortage Myth, because I think we definitely have a shortage of affordable homes, but we don't have a shortage of housing units. You can just simply, divide housing units by population. We've got more housing than we've ever had. And so I think that a lot of people thought we needed to build homes, and there wasn't a lot of building, but we had already overbuilt. And you can look at the Harvard, joint, their housing policy group, and talking about our demographics now, and that we pulled forward so much demand. And so I think that as the silver tsunami descends on us, we're going to have a ton of inventory come to the market that a lot of people aren't expecting. And then, of course, you had the short-term rental craze that's petering out. And the other thing I'll say is I've actually driven all over the country to these markets and looked at the supply and what we're seeing in permits, what we're probably seeing, because there's a lot of areas like in Texas and other places where you don't actually even have to file permits. But there's probably 25% more supply out there on just the new home inventory than what most people think. And then there's so much vacancy as you drive around these cities because you had people buy to fix and flip and then they ran out of money. Or, you just have these second and third homes that are owned by the boomers. Per the census, we have about 15 million vacant homes, not abandoned. So I think that the supply is out there. I think it's mispriced. And there's certainly areas where you might need some, but Ken, what I've seen on the road is staggering. And it's, we have absolutely overbuilt in this cycle. And I think that was done based on kind of misunderstanding about population gain, especially in the Sun Belt. But sorry, I know I said a lot there, but I just wanted to kind of
No, I fascinating. But I have a question though. So if because I follow permits, I follow obviously interest rates, and what happens when interest rates go up, permits go down, because it's more expensive to build. And so, and I'm a builder too. So we, we're actively out there. And so when rates go up, people sit on land for longer. And so, but I watch the MLS numbers, and so I know, so if we have that much inventory out there, why isn't the inventory, the vacant house at least showing up? Because we had, in 2022, we only had 400,000 homes on the MLS. And in 2008, we had 4 million. So somebody in 2008 put 4 million homes on the MLS, and somebody in 2022 put 400,000 homes on the MLS, which means that 3.6 million homes got absorbed, in 14 years. And so, but I also know from personal experience, what was not going on after 2008, after the pop, was building, because the banks had taken on so much real estate, so much REO, or real estate owned, and there was water going in the boat the whole time. We were dealing with Bank of America, Wells Fargo. We even had some deals with Lehman Brothers, and the values were dropping like crazy, so they were not lending. So I personally know that there's no homes being built post GFC. So, right. But let me tell you what there was happening. People were being born. people were graduating from school, household formation did go up. It's at 133 million right now. So, so we did have household formation going up during that time and no supply being added. And I actually love the Harvard study that you brought up. I like Brookings and I like Harvard because they're independent,
Right.
They're independent, the National Home Builders or the NMHC or Realtor or Zillow, because they're all over the map. And I've really dug in. I've read all of those, and to me, the math looks pretty clear that
Right.
You've got at least over 3 million short, and that was predicated from call it post GFC. Now, people did start building again, but right afterwards, the banks aren't lending during that period.
Yeah. I mean, I worked for one. So,
Yeah.
I managed default. I worked at, GMAC ResCap. We were a top 5 originator and servicer. So, I was there when I saw Wall Street starting to buy up those foreclosed homes. But what you'd had before that, Ken, was a lot of speculation in the market.
Oh, for sure.
And in reality, since the 90s, that was occurring. And so if you look at average household size and what it used to be versus what it is now, very different. It was
lot smaller.
4, a lot smaller. And so I understand a lot of people that's the understanding, because that is absolutely a fact. There was not building, but we had already overbuilt. And then those permits, essentially, so we've got to think about just kind of the demographics and the fact that we're not, birthing babies like we used to. The fact that most of our population gain over the last couple of years was, due to immigration. And so what you can see out there right now, and this is why, for me personally, because I live that, I had a builder group that, stopped building. I live that whole thing that you're talking about. But what I could see based on just those census numbers about those vacant homes, all of this. So to your point about why weren't they on the MLS, there's 2 reasons. One, the MLS is less relevant than most people understand now. There were people during COVID selling on Facebook, selling short-term rentals on Facebook. They'd be gone in minutes. And, back then, Zellman was arguing as well that, the reason there were so few listings on MLS is because it was just all turning so very quickly. And so nobody could really keep up with what was going on. But if you take a picture of San Diego, for instance, and you look at, if you go to Inside Airbnb, you can see how many short-term rentals, they completely took over that market. And so you have to look at, many of these markets have very low owner occupancy. And what they did, like Austin, San Diego, others, is that you just had this rampant speculation on short-term rental in Nashville. And so that's where a lot of this inventory is sitting. And as we've started to see travel being impacted and kind of enter a downturn, you're seeing more and more motivated listing of those short-term rentals. And we're going to just continue to see that, while at the same time, the boomers will be aging out. We'll lose 15.6 million between now and 2035, and another 25 million, and they own the majority of the homes. And, Charles Schwab has done a study. It said that, for people when children inherit the homes, they sell 70% of the time. And what I'm starting to watch undercover in a lot of these markets is homes where the owners have deceased is increasing significantly. And so you're going to have those homes coming onto market. Their kids can't afford a lot of them. I'm helping some folks like that right now. And so I think that there's that. And then because the math does look so clear, right? Because when you're just looking at building, but not necessarily when you look at kind of what housing became, and it became about, investing. It became about, a lot of the boomers are doing that long-term rental. And so now when you look structurally on how many people do we have more housing that we need. And, so what I was saying is I went out on the road because it was impossible to try and convince people of this because of that experience that folks had after the GFC, because there had not been building. But what you're seeing all over the country now is that, the nationals go building. They went crazy in many of these markets. And then the local regionals came in and did the same thing. And the two groups don't really talk to each other. And then, secondly, my point that I was saying to you is that I would look at permits in Austin, for instance, and then I would go and look at what was under construction, and it wouldn't match at all. And so we're missing a good deal of that inventory, again, because some of it is in unincorporated areas where you don't have to file permits. But the other thing I'll quickly say is on the MLS, in 2015 at their national conference, NAR did a study talking about private listings and how this was all the rage and it was stealing their market share. And what I have definitely noticed is that there are more private listings. There was a study done in Austin that almost 50% of transactions happen off the MLS. And so I think that we're looking back and we're saying, okay, the MLS then, the MLS now. Well, social media has really changed the way that we buy and sell homes. And NAR's not going to talk about it because they don't want to admit it. But this is definitely happening out there. And a lot of people are operating outside of the MLS. So I think that's one reason why you didn't see all that inventory.
Let's start with Ken. Ken, when we're focusing on sellers today versus sellers in 2008, how do you think that plays into what could happen with the housing market?
Well, in 2008, the seller did not have any equity. I think that's the big issue. So now I'm generalizing, of course, because some certainly did, but those, obviously, if you have equity, you don't show up as a foreclosure. I mean, you use the equity to pay your debt, and so the bank doesn't take a write down or anything. Like it's like it's a savings account. So that's one huge thing. We did have a run up in prices, even from early pandemic to now. I think we went up $100,000. We're still up over 400 on the average. And also in 2008, the water level went down across the whole country. The Market Watch just did a study for 2025 of the top 100 cities in the U.S. 22 went down and 78 went up in last year. So to me, in 2008, that was not the case. In 2008, everything just free fell because, of what happened then. So, and so there was this big shift of, from home ownership over to the rental side of the equation. And also, don't forget, we were at 69% home ownership. Okay, that put that, and I'm in the rental space, so that put 31% in the rental side of the equation. So every 1% tick back to, let's call it 65, as I think where we're at today, is millions of people. So millions of people move from home ownership over to the rental side, and that's actually what fixed and corrected the rental market. Even though right now it's disrupted because of the new construction and the low rates, from 2-3 years ago. Right now rents are soft, and that's a whole nother discussion. But that's why we're buying in the rental market. But when people move over, from the home ownership side to the rental side, it puts pressure on the rental side. Obviously, that also increased the amount of supply on the homes, as that happens. So, we're not seeing that right now. We're seeing the 65-35 kind of, it's just been very interesting. Trump, whether you like him or not, he's trying to push affordable housing. He's talking about American Dream, no different than Clinton did, no different than Bush did. Now, could be politics, could be whatever, but at the end of the day, he's focused on using people's 401ks potentially. He's talking about portable mortgages. He's talking about 50-year mortgages. He's talking about all this stuff to try to lower affordability for homes. And so, something's going to land. Something will be successful in the next few years, especially after he gets his new Fed chair in there. And I personally think we're going to start, as you start to see the rates go down, people are going to start to unlock some of that equity that's sitting in their homes. And it's going to start to flow. It's going to increase GDP and all that kind of stuff. So it's very different than 2008. We had 4 million listings on MLS. That's a fact. That's a number. You can't dispute it. And it took almost 12 years before it fixed itself. It's over a decade. And we just don't have that right now. I just don't see that kind of, that kind of pressure. How can 78 markets in the U.S. go up if we're having a correction?
Yeah, I think what we're seeing is that the median is being supported because the transactions are so low. And who's transacting? There's two different groups kind of transacting over the past couple of years. That was the top 20%, really the top 10%. And then those FHA borrowers who were also getting down payment assistance because there was just so much money thrown at the housing market. And a lot of those COVID American Dream funds went into down payment assistance. And so it's sustaining those home prices to some degree at that higher level because transactions are so low. So personally, I'm hopeful rates, we saw some action on Friday. I hope rates go down because I think you're going to have more transactions, which will give you that price discovery. But as we kind of rounded the end of the year into January, I track 85 markets each week and just all of the metrics. And half of my markets, and I get the biggest ones, were showing price declines. And that started to accelerate at the end of last year. You've now got the median list price at a national level below $400K for the first time since 2022. And it's now down year over year for the past couple of months. So I do think that there are markets where you're seeing transactions, Ken, you're actually seeing prices go down. Like in California is a big one. And what's happening right now over the past couple of weeks in California specifically is inventory is starting to explode. I don't know if that's because of the crypto route or what's going on there. But it is definitely starting to increase, non-seasonally. And so I think the sellers got, we saw the highest number of delistings we've seen since Redfin started tracking it. What one of my colleagues, John Brooks, says is like rage delisting when they couldn't get the price they wanted. But what you're starting to see is distress intensify, and I oversee mortgage books. You're seeing delinquencies start to tick up. And to your point about this is not 2008. No way. Where we are right now is about 2006. and this is what so few. I was in mortgage. I watched credit quality go from pretty good. Yes, we had about 10 to 12% of subprime on our books at that time, around 2008. But what you saw from 2008 to 2012 was just degradation in the prime books. And I think that we're actually positioned, if I had to think about what year it is, because of all of the massive intervention, the forbearance is this crazy program on FHA where you could just stop paying and keep going back over and over and over. They put the guardrails on that. It started in October. But we're basically at that 2006 level because of all the intervention that we had at the end of the last cycle, we did it up front. And so now we're just kind of coming over the top, and you're starting to see credit quality degradation in the prime books as well. And that's on top of them selling off their non-performing loans. And so when you look at their delinquency statistics, you have to remember they've already sold off a lot of those delinquent loans into the market so that their overall statistics don't look that badly. So I think that, go ahead.
Well, I was going to say, do you see, because I know that most of the distress right now is in the FHA as an overall. Do you see that there a situation where that could happen, but yet not bleed into more of the conventional loans and conventional side?
I don't think so, because where we are right now, so to Ken's point, and he's absolutely right, we don't have a ton of underwater mortgages, but we are starting to see that increase at a very accelerated rate on FHA. I think there's now 1 million underwater FHA loans. And the thing about it is you only need one foreclosure in your neighborhood to start impacting those comps. And again, I'll mention those private actors that aren't getting reported to credit. They're already moving. They're already doing these distressed sales. And so I don't think so because of the same thing that happened last time. We've got layoffs increasing. I mean, Challenger just said we had the highest layoffs in a January since I think 2009 or 2000, one of those years. And so I think that we are just now getting to the point of the cycle where the prime books are going to be impacted. And so, again, I think even Realtor, they have their vested interest, right? Basically said there's 3 ways that we can improve affordability. Rates have to go down below 3. Prices would have to correct by 35%, or wages would have to go up by 50%. That's from the industry show. And so, and I even think, because I remember 2010 very well, Ken, you probably do as it was like this one year we got a pause on the crisis because people did go into refi. That's what they did. It was like a mini refi boom. But what you're seeing right now is the Fed in its last survey of consumer expectations, mortgage refinance rejection rates were over 43%, the highest since they started tracking. We hit a similar number last February, but that's massive. And so people that you would hope would be able to unlock that equity, a lot of them won't be able to because those student loans that weren't reporting to credit when they started, and there's still millions of them not reporting, they took prime borrowers down 200 points in some cases. And so, unfortunately, I think we will probably have a little boomlet like you're talking about if we keep seeing rates go down from here. But it's not going to be as effective as I think many believe, the same way that 2010 was not either, because people just could no longer access that credit. They basically can no longer qualify.
I'm sure those numbers are accurate. I want to, if I could, just if we take it from Wall Street down to Main Street, I'm a simple guy. So like if I have a listing and there's 15 cars out front and the price is blowing above the listing price, typically there's either a shortage, a lot more demand of buyers for why? Because of the low mortgage, let's say, interest rates, or maybe there's not enough homes. So I look at the other way too, right? So we're starting to see this normalization, and I actually think that's what this is. I think that the sellers have been in the driver's seat for a long time, and we saw a 40% increase after COVID, like from 2020 to 2022 in the home prices. Like they went from 300 to 400 just like that. I was like, what? I guess so. If you didn't have to do anything, and your home went up on average $100,000. And so we have a long way to fall. And you're right. Even if it goes down 40%, it just goes back to what it was in 2020. But I think, I look at it from the Main Street, which you're right. There's fallout, there's Airbnb, there's all that stuff. We're seeing all that stuff. It's gobbled up. But really, I think one of the fundamental issues of the low MLS numbers is that the majority of the country is sitting at 4% and under rates. They're just sitting there, and there's zero motivation. If you have a $400,000 or $500,000 house at 3%, you can't rent, you can't trade out, you can't do anything, because whatever you do is going to be more money to you. And so I think that's what they're trying to go after. In 2006, what you mentioned, federal funds rate was 0. I mean, that's a huge difference. Now it's 3.5, let's say. I think we have this, and what I watch, I actually was buying in 2005, 2006, and it popped, and all of a sudden, whatever I bought during that period of time was worth a lot less. And so I felt the pain during that time. But, so I look at the Main Street, and I just don't see personally that what I think I like our mutual friend George Gammon's quote. He's like, the cure for high prices is high prices. And so you could be right in this situation where, we kind of started there with the affordability issue. People cannot afford a $400,000+ home at 6.5%. They just can't. There's being in the rental business, there's almost 1,000+ more on the mortgage than the rent. Rents, I think, around 1,700 average for the country, and mortgages are 27, let's say. So right. It's a huge gap, and it's forcing people into the rental market at the moment.
Right. I agree with you on the kind of the lock-in effect. I think we just got to the point where we're about the same over 6 as we are under 3, but my dad is one of these seniors, and he can't buy a like home. Like he's going to lose his equity if he moves. But the thing that I'm starting to see, and I use a tool, they don't sponsor me, but it's called Property Radar, where you can go in and they track, divorce, death, and things like tax liens, owner liens. And what you're seeing in these markets is the rate of deaths is accelerating. And so I think that we're actually going to get a lot of those under 3 homes to market, unfortunately, that way. Because, as I mentioned, the kids just can't afford these homes. They can't pay the property taxes or insurance. In many cases, I travel all over the country, and I always like to look at the local news when I'm in a city so I can kind of understand what's going on. And there, every single time it's somebody at a city council meeting, complaining about their property taxes, that it feels like a mortgage. And then the same with, insurance has. One of my large servicers told me, just looking at their book, number 3 servicer in the country, that insurance has gone up by 50% since 2020. And so what I'm seeing is these escrow notices go out that are 2 and 3, like double the payment. It's insane. And so I think that, what you're going to have is you're going to have people that sort of age out, and you're going to get that inventory there. That's how you're going to get out from under that lock-in effect. And then we're starting to see distress elevated, where there is actually no choice. And those guardrails on that FHA program are massive. Like what was happening there was just absolutely unbelievable. And so it's going to kick this stuff loose. Now, again, the government could get involved. Like if we start to see foreclosures increase, the state AGs might get involved to slow that down. But I think basically, to George's point and what you repeated, the cure for high prices is high prices. And if you just look at household median income, we are so out of whack. I just don't see who's coming to buy. And with the builders undercutting, we haven't had prices for 3 months with the builders. We know that they were below 400, the last one they reported. And we know that they are reporting in their earnings that they're upping their incentives. But you've now had historically one time in the past, since 1999, where new home prices more or less expensive than existing home prices. And we've now had a full year of that. And that's how distorted the market is. And so I just think the affordability is going to, it's going to crush it. And I just don't see, unless we do see wages increase, because I don't think rates are going to do it personally. That's my view.
I agree with you completely. Getting back to the human component side of this, which is, really extremely good thing to discuss, is, wage growth and inflation is crushing the person. Yes. That's outside of the system, that's not in the hard asset, right? At least, right? I'm talking about the renter. I'm talking about, the people that we have. We have 10,000 apartments. We have 10,000 renters. The person that's outside of the system, outside of the hard asset is the one getting crushed. I think, Danielle and I do. Obviously, we get a lot of people on a podcast, and we had a very interesting discussion with somebody who was dealing with the Canadian housing market. Mm-hmm. And so we'll just jump north real quick. But at the end of the day, the home prices in Canada are twice as much as the U.S. They're actually almost 800,000. So that's across the country. I mean, you go into Toronto, Vancouver, some of the core cities that, they're well over 1 million. And they have the exact same issue where they're not necessarily making a lot more than us. But they have a lock-in effect on a lot of the folks there. Obviously, because they're living in these homes for a long time. They are trading for multiple reasons. But I think I just seeing what happened in 2008. I just don't see a correction. I think in order for there to be a distress, there's different levels of distress. There's bank distress, there's equity distress, which is, let's call it the homeowner. I don't see the Main Street distress as a result of the equity, personally. And anybody who passes it, as you mentioned, they get that step up in basis, right? So it resets, so they don't have any tax problem. They just get to scoop the equity if there is any, of course. But to your point, and I'm the first to say my kids are going to sell and run, right? They're going to take whatever they can, and I think that is for sure going to be something. But that'll be a very, very interesting thing. But I think supply is what drives prices down, and I just don't see it right now.
And so I agree with you, and I do see it.
Yeah.
And so, just going out to these markets. But the other thing I want to mention on the equity piece, one other aspect is private credit. And what private credit did, and I've talked to some of these companies, is, hard money lenders are usually very regional, understand their markets, will ask for, 40% down payment, high interest. Well, private credit came in and basically said, well, we can use algorithms and we can lend. So there was let's take this company Notable that would give you a $50,000 loan to spruce up your house that you pay once you sold that home. And so you have a ton of these types of lending schemes out there that, again, aren't necessarily reporting to credit. And so the equity picture, I don't think is as pristine as everybody thinks. And I mean, this is something I'm seeing looking at client books. This is also something I'm hearing, talking to people. And then these private credit folks, there was just an article, I think in the Wall Street Journal last week, just about the fact that these guys went out and basically made hard money loans, but thought that they could do a 90% LTV, thought they could take and not really be as strict as, say, your typical hard money lender. And so I think that we'll start to see this supply. We really saw it last year, but a lot of people delisted. But I think you're going to get even more supply, especially if rates get a little lower, because as there's activity, more people are going to start coming to the market. And right now, and this is the thing, down the street from me, there's a house I've been watching. They went on in August. They've reduced down to 50,000. They just pulled it off the market because, the realtor's telling them it's winter. You're not going to get a bite. So I think the spring is going to be very telling. And then as that FHA starts to get worse, as your Fannie Freddie starts to deteriorate, you're going to see more and more distressed properties come to market. So I think that the supply issue is going to be, it won't be an issue here very shortly in the near term. I don't think so this year, but definitely by next year.
Yeah.
So you're both very smart people. So I think people are going to, want to know what you guys are following. So Ken, what's one data point that you're watching this year and next year as far as the housing market is concerned?
Well, we started with it. It's affordability. And it's really easy to track what the mortgage payment is, plus property tax, insurance, utilities. You're talking about well over $4,000 to live in a home at a $400,000 number, and rent. Rent's getting whacked right now. So those are the two things I watch as I invest. The one other thing is to mention is I really watch the difference between the home ownership rate and the rental side of the equation, because depending on policy, that can change dramatically. So if Trump really pushes this, first time home buyer thing, let's say, whether he does or doesn't, we don't know. But if he does, those people are coming out of rentals. That's going to affect the rental market. Most of them, and so I think it's those are the two main things that we watch as we move forward. Obviously, the big we didn't really touch on this, but the big wild card where Melody could be spot on is this unemployment issue, and the wages. That is going to be, we're at 4.2, I think right now, 4.2%, which is the Fed's okay with. But if we get up over 5 and even into the 6%, we could see it could be a very different picture.
Yeah. So, and Ken, I think importantly, right, it's the youth unemployment is insane right now. 18 to 24, those people that we would hope would be forming households. I think I'm probably gonna get my numbers wrong, but I think that they're in double digits right now. And then the second cohort, youngest cohort, is over 5% already. And so I'm watching unemployment. I'm watching supply like a hawk, and because I think that's key. And the policies I've reviewed, and I honestly think it's they're throwing spaghetti at the wall in terms, because if you go, so I do this thing in my Substack where I'll do a deep dive into a city that I visit, or maybe just kind of look at all the macro and micro factors there. But you can essentially see in all of these cities, they had these crazy down payment assistance programs already, like where you get 25,000, 30,000. And so I believe what we've done is we've pulled forward as much first-time homebuyer demand that we could artificially pull forward. And then we're at a point now, because of those student loans, that they're just not going to qualify. So, I'm watching this package. Like, what am I watching? I'm watching this bill that's been in committee. I can't remember who just passed. One of the I think the House, but a lot of it's just more of the same. And what I know is that more of the same is not going to change things in the housing market, because there's been plenty of money out there for first-time home buyers, believe it or not.
Well, thank you for coming on the show, Melody. It was really nice having you. It's always a great to have a second opinion on what's going on, and people can kind of study both of your conclusions. And for those listening, please comment below what you think. We'd be so interested to hear those comments.
Yeah, Melody, awesome stuff. Thanks for bringing receipts too.
Well, thank you so much for having me. It's been a lot of fun.
Yeah, thank you so much.